Why bad credit can keep you stuck in the expensive tier level 1, negative balance. Your checking account is negative, maybe by $12, maybe by $300. The amount matters to you. To the banking system, the important part is simpler. There is not enough money. You stop at a gas station, swipe the debit card. Declined, you try again because maybe the machine made a mistake. Declined again. Now somebody is standing behind you while you open the banking app and perform math you have already performed 6 times today. This is what being financially underwater normally looks like, not bankruptcy court. Not somebody taking the house, just a debit card declining while strangers wait. If you opted into certain overdraft coverage, the bank may let the transaction through and charge for it instead. Overdraft fees vary, but the CFPB says many banks and credit unions still charge $30 or more per transaction, and multiple overdrafts can potentially create multiple fees in one day. The math is almost cruel. If you had more money, there would be no overdraft. Because you do not have enough money, the shortage itself can cost more money. At this level, there is no relationship. There is a system. Low balance alert, overdraft alert, returned payment alert. Nobody inside the bank wakes up worried about your account. Nobody knows that your employer deposited the paycheck late. Nobody knows that the $47 subscription was something you forgot to cancel. The system knows one thing. The money was not there, and it responds automatically. That is level 1. You are not trying to get the best financial products. You are trying to make Friday arrive before the money disappears. Level 2, low balance. You escape the negative. There's $400 inside the account, sometimes $700, maybe $1,000 immediately after payday. Then rent hits, insurance hits, utilities hit, and you return to the same few $100s. You are no longer underwater. You are standing with your nose barely above the surface. The bank provides everything you technically need: checking account, debit card, ATM, mobile app, customer service. But nothing about the relationship is designed around keeping you. If your account charges a monthly maintenance fee, the bank may waive it when you maintain a certain balance or receive qualifying direct deposits. That creates a strange financial reality. The person capable of leaving thousands untouched can sometimes bank for free. The person who needs every dollar may pay for the account. You apply for credit. Maybe the unsecured cards say no. A secured card becomes an option. You provide a refundable deposit that protects the issuer. Maybe $300, and the credit line might also be around $300. That does not mean the bank is charging interest on your own deposit. The deposit is collateral. Interest becomes a problem if you carry an unpaid card balance under the card's terms. But emotionally, the message still feels obvious. The bank does not completely trust you yet. So you use $30, pay it. Use $40, pay it. 1 month becomes 6. 6 becomes 12. You are not building wealth yet. You are building evidence. Evidence that the person managing this account today is more predictable than the person who struggled yesterday. At level 2, you have access, but almost no leverage. Level 3, stable income. Then the pattern changes. A paycheck begins arriving consistently, $3,500 every month, then maybe $4,500. The bank notices, not because somebody at headquarters claps when your direct deposit arrives. The systems notice the pattern. Consistent deposits, regular transactions, less time near zero, fewer overdrafts. Now the app begins showing offers, a credit card, a personal loan, an auto loan promotion. 6 months ago, you were trying to keep the debit card working. Now the same institution wants you to borrow money. This is when people learn something important about banks. Banks do not only want people who have money, they want financially useful relationships, deposits, card spending, loans, investments, mortgages. Your paycheck creates opportunities for the bank to make money with you, so the treatment improves. But there is a trap here. You think the raise fixed your financial profile. It did not necessarily fix your credit. You can earn $90,000 a year and still have collections, charge-offs, recent late payments, maxed out cards, too many recent applications. The bank can love your direct deposit and still hate your loan application. Those two things can exist at the same time. One department sees $7,500 coming in every month. The lending system sees 3 late payments and 92% utilization. Income tells them you have money coming in. Credit tells them what happened the last time somebody expected you to pay money back. And that difference gets expensive. This is where credit repair actually matters. Before another car application, before the mortgage, before another credit card, pull your reports, look at Experian, TransUnion, Equifax, check whether the accounts belong to you. Check late payment history, balances, limits, dates, collections, closed accounts. The CFPB specifically tells consumers to look for things such as accounts belonging to someone else, closed accounts reported as open, incorrect late payments, incorrect balances or limits, and the same debt appearing more than once. If something is genuinely inaccurate, dispute it. If the late payment is correct, do not pretend it was fraud. If the collection belongs to you and is accurately reported, do not send a magic letter claiming it never existed. Accurate negative information generally cannot simply be removed because you dislike it. Genuine inaccuracies can be disputed directly with the credit bureaus and furnishers at no cost. For what is accurate, rebuild, lower the balances, pay on time, stop applying everywhere. Let clean history replace chaos. This is the difference between having more income and actually becoming cheaper to lend money to. Level 4, growing savings. Now you have margin. Maybe $15,000 in savings, another $25,000 invested. The credit cards get paid in full. The emergency fund finally exists, and something strange happens. Emergencies stop becoming debt. The car needs $800 in repairs. At level 2, that becomes a credit card balance. That balance raises utilization. Then interest, then the minimum payment, then maybe a missed payment somewhere else. One repair becomes a 12-month financial problem. At level 4, the same repair comes from savings. It still hurts, but it dies the day you pay it. That changes everything. Your credit profile may strengthen. Your limits can increase. Better loan offers may appear. But more importantly, you finally have the ability to reject bad ones. You want a car. You do not walk straight into the dealership asking, "Can you get me approved?" You go to a bank or credit union first. You get an offer. Then you walk into the dealership and say, "You can finance it if you beat my rate." That is leverage, not being rich. Having options. The bank also sees something different. Your deposits remain longer. Your savings are growing. Your card is active but controlled. Maybe investments are attached to the same institution. You have become more valuable and potentially less risky at the same time. That combination gets attention. At level 1, the bank was protecting itself from you. At level 4, the bank is beginning to think about keeping you. Level 5, preferred client. Now your combined qualifying assets reach something like $150,000. This number is not a universal banking rule. Different institutions have different programs. But here is a real example. Chase Private Client currently uses $150. 000 or more in qualifying linked deposit and investment balances as one way to waive its $35 monthly service fee. The relationship includes a dedicated banker, 24/7 priority service, certain ATM and wire fee waivers, and access to specialists for lending, business, and wealth needs. Think about how far the experience has moved. At level 2, you worried about avoiding a monthly checking account fee. At level 5, certain fees are being removed because the bank does not want small annoyances making you move $150,000 somewhere else. The teller is no longer the relationship. You may have a person, a name, a phone number, someone who can bring another specialist into the conversation. Mortgage, investments, business banking. The relationship becomes personalized, not because the bank suddenly loves you, because losing you now matters more. You also start receiving more sophisticated pitches, premium cards, investment services, home equity products, mortgage relationship pricing. But remember the credit lesson. Having $150,000 does not magically make a damaged credit report disappear. Money gets you attention. Strong credit helps get you trust. You can be a valuable banking client and still receive a disappointing unsecured loan decision if the credit file is damaged enough. The bank knows your name now. It still reads your report. Level 6. Wealth Management. Now the financial picture becomes larger. Several $100,000, maybe $1 million, maybe more. There is no universal number where every bank suddenly calls you high net worth. The thresholds vary. What changes is complexity. Your financial life is no longer checking, savings, one credit card. Now it might include retirement accounts, a brokerage portfolio, business ownership, real estate, insurance, estate planning, tax considerations, maybe trusts. The bank wants to understand all of it. You start hearing a different type of question. Not, would you like to open a savings account, but what are you trying to accomplish over the next 10 years? That sounds more sophisticated because it is. It is also commercial. The more of your financial life the institution understands, the more of your financial life it may be able to manage. You may now have an advisor and banker working together. Problems can receive more direct attention. A wire gets delayed. A fraud alert freezes an account. You do not necessarily call the general number and explain everything from zero. You call somebody who knows the relationship. But there is a new danger here. At lower levels, bad products are usually obvious. High fee, high APR, bad loan. At this level, bad decisions can wear expensive suits. A product can sound sophisticated and still be wrong for you. An advisor can sound intelligent and still have incentives you need to understand. More access does not remove the responsibility to read. Fees, risks, conflicts, loan terms, investment structure. At level 6, banking becomes more personal. That does not automatically make every piece of advice better. Level 7, very high net worth. Now we are talking about several $1 million. At this point, the world of finance begins showing you doors that were invisible before. Private investments, private credit, venture capital, real estate deals, alternative funds, specialized lending. But do not confuse being wealthy with being qualified for every private investment. Under current SEC rules, an individual can qualify as an accredited investor through several paths, including net worth above $1 million excluding the primary residence, or qualifying income above $200,000 individually or $300,000 with a spouse or partner for the prior 2 years with a reasonable expectation of the same current year income. So the magic number is not universally $5 million. And being accredited does not mean an investment is good. It means you may legally have access to opportunities that may not be available to ordinary retail investors. That access comes with risk. Private investments can have limited liquidity, less transparency, large minimums, long holding periods. You can no longer judge something by asking, did the stock go up today? There may be no daily price, no sell button, no easy exit. Your financial team can expand. Investment advisor, tax professional, estate attorney, private banker. The bank is no longer trying to sell you one product. It is competing for the entire ecosystem around your wealth. And this is where money creates negotiating power. Rates can become relationship driven. Fees may become negotiable. Structures can become customized within the bank's policies. At level 2, you accepted the rules. At level 7, you may be discussing which version of the rules makes sense for the relationship. Level 8, private banking. This is where the experience stops looking like normal retail banking. Private banking minimums vary dramatically. But Citi Private Bank provides a useful current example. It states that its services have a minimum investment level of $5 million. At this level, you are not choosing from the same menu as everyone else. The bank is trying to understand the complete structure: businesses, properties, investments, trusts, estate planning, family wealth, charitable giving, large borrowing needs. Liquidity. You might not ask, what mortgage can I qualify for? The conversation may become, should we sell investments to buy this property or borrow against certain assets and preserve liquidity? That is an entirely different question. At the bottom, you were searching for money. At the top, you were deciding which pool of money should solve the problem. Private banking can involve customized credit structures and specialized advice, but wealthy clients are not living under different laws. Banks do not get to ignore regulations because someone is rich. What changes is the amount of lawful discretion, customization, staffing, and attention an institution may be willing to dedicate to a relationship worth millions of dollars. At level 1, a computer sees a negative balance and reacts. At level 8, a team sees a complicated financial problem and asks, how can we structure this? That is the distance. Same industry, sometimes the same bank, almost a completely different experience. And here is the entire ladder. At the bottom, the bank charges you because you have no margin. Then it gives you basic access. Stable income makes you interesting. Clean credit makes lending to you cheaper. Savings gives you the power to avoid debt. Assets make the relationship worth retaining. Wealth creates personalization. Very high wealth creates negotiation. And private banking turns you from an account into a relationship. That is why wealthy people appear to get better deals. Not because banks became nicer. Because banking is a business. The institution is always asking two questions. How risky are you? And how valuable is this relationship? Your credit score answers part of the first question. Your income, savings, investments, and total relationship help answer the second. And this is why bad credit can be so expensive. You can finally start making good money and still be carrying an old financial file into every new application. Collections, charge-offs, incorrect late payments, high balances, duplicate reporting, old mistakes, possible reporting errors. The paycheck changed, but the file did not. So before you chase another loan, another card, or another vehicle approval, understand what the lender is going to see. Review the reports. Correct genuine inaccuracies. Lower the balances. Protect every payment. Build savings. Then shop between lenders instead of begging one lender to say yes. Because the goal is not to become valuable enough that a bank offers you more debt. The goal is to become strong enough that you do not have to accept bad debt. At the bottom, you ask, will the card go through? Then, will the bank approve me? Then, what rate can I get? Then, can you beat the other bank? And eventually, why should I keep my money here? That is how the game changes.